The Balanced Scorecard, also known as BSC or Prospective Dashboard, is a very popular management tool. It was created in the 1990s by Robert Kaplan and David Norton, two prominent researchers from Harvard University. They were convinced that measuring a company's performance could no longer be limited to evaluating only financial results. The model is thus based on financial indicators to ensure the increase of shareholder value. Here, we refer to the financial perspective. Indicators that provide information about customer satisfaction. Here, we refer to the customer perspective. Indicators corresponding to the various drivers of the organization's competitiveness. This is called the internal process perspective. And indicators related to intangible resources. This is the learning and innovation perspective. The starting point of the BSC is always the company's strategy. This strategy is broken down into strategic objectives for each perspective, linked to specific indicators and accompanied by concrete action plans. What sets the BSC apart from other management tools is that it is not only a performance measurement tool, but above all a strategic management tool thanks to its causal approach. Indeed, financial and non-financial indicators are connected, which makes it possible to identify cause and effect relationships and align managerial actions with the overall strategy. For example, let's imagine a consulting firm that was initially focused on financial auditing. If I increase the number of consultants trained in the latest non-financial regulations, here we are in the learning and growth perspective, I will then be able to launch a new service offering dedicated to non-financial auditing, which falls under the internal process perspective. I gain new clients, customer perspective, and ultimately increase my revenue, financial perspective. However, the BSC also draws criticism, particularly regarding the concept of causality. Some researchers specifically argue that the links between the different dimensions are not always valid, and that the idea of a hierarchy among these dimensions, which ultimately emphasizes financial performance, is not always relevant. Through cause and effect relationships, the BSC model subordinates the other three perspectives to the financial perspective, whose ultimate goal remains to ensure the increase of shareholder value. Today, integrating corporate social responsibility into the Balanced Scorecard is essential to ensure sustainable performance and meet stakeholder expectations. The organization has two options: a limited integration of CSR management into the organization's management system by adding a fifth CSR perspective to the BSC. This option ultimately reflects a CSR strategy that is still disconnected from the overall strategy, indicating an initial level of maturity. Alternatively, a full integration can be achieved by incorporating CSR indicators into the four perspectives of the BSC, which would indicate an advanced level of maturity where CSR is at the heart of the company's strategy.